Have you ever listened to people talk about stocks and felt completely lost? Terms like bull market, bear market, dividends, price to earnings, short selling,
What?
volatility. You're not alone, but deep down you have no idea what they mean. Don't worry. In the next 7 minutes, I'll explain these terms in the simplest and clearest way. After this video, you'll never feel confused when people talk about stocks again. Chapter 1. What are stocks, shares, and equity? When you buy a stock, what are you actually buying? A stock represents a tiny piece of ownership in a company. Imagine the company as a big pizza, and each slice is a share. The slices you own are your shares, and the more slices you hold, the bigger your ownership becomes. So what is equity? Equity is the value of the company after all debts are removed. The part that belongs to you is your shareholder equity. In simple terms, buying a stock means buying real value inside a company, not just a piece of paper. Chapter 2. Dividends, price to earnings, market cap, and earnings per share. These four terms are essential for understanding any stock. 1. Dividends. Dividends are payments a company gives to shareholders from its profits. If a company consistently pays dividends, it usually means it earns money steadily and has strong cash flow. For beginners, these companies are often more reliable and stable. 2. Price to earnings ratio, also called PE. The price to earnings ratio tells you how many years it might take for the company's profit to match the price you paid for the stock. A high ratio often means investors strongly believe in the company's future growth. A low ratio may mean the stock is undervalued, or it may signal problems with the company. It all depends on context. 3. Market capitalization. Market capitalization reflects the size of a company in the stock market. Large companies usually move more steadily with smaller price swings. Smaller companies tend to move more dramatically and are more sensitive to market changes. 4. Earnings per share, often called EPS. Earnings per share shows how much actual profit a company generates for each share. It is one of the clearest indicators of a company's ability to make money. Higher earnings per share often means stronger performance. Learn these four concepts and you will already understand the foundation of stock evaluation. Chapter 3. Bull markets and bear markets. A bull market is a period when investors feel optimistic and believe stock prices will keep rising. During a bull market, everyone suddenly becomes a stock expert and people feel confident about making money. A bear market is the opposite. Investors become fearful and expect prices to drop. News headlines often sound negative and the overall mood becomes cautious. Bull and bear markets are reflections of collective emotion. Understanding both helps you avoid blindly following the crowd. Chapter 4. Technical analysis and fundamental analysis. There are two main ways to analyze stocks. Technical analysis focuses on price charts. It studies trends, trading volume, support levels, resistance levels, and price patterns. In short, it tries to understand what the market is currently doing. Fundamental analysis looks at the company itself. It examines revenue, profit, debt, growth potential, and overall business quality. Technical analysis focuses on price movement. Fundamental analysis focuses on real value. The best approach for beginners is to combine both. Use fundamentals to decide what to buy, and use technicals to decide when to buy. Chapter 5. Short selling, margin trading, and volatility. These are the terms beginners must understand before taking risks. 1. Short selling. Short selling is a method where you sell a stock you do not own by borrowing it first. You sell it at a higher price, hoping to buy it back later at a lower price and return it. If the price drops, you profit. If the price rises, your loss can grow without limit. That is why short selling is considered extremely risky. 2. Margin trading. Margin trading means borrowing money to buy stocks. When the stock rises, your profits increase faster. But when it falls, your losses also grow faster. In extreme cases, your account may be forced to sell your positions, and you could lose your initial investment. Beginners should stay away from margin trading. 3. Volatility. Volatility describes how wildly a stock price moves. High volatility means prices jump up and down quickly and unpredictably. Low volatility means the stock moves more steadily and predictably. Short-term traders often like high volatility, but beginners usually struggle with it. Long-term investors tend to prefer more stable stocks. Chapter 6. Liquidity, trading volume, and bid-ask spread. These factors determine how easily you can buy and sell. 1. Liquidity. High liquidity means you can buy or sell quickly. Low liquidity means your order may sit there for a long time with no one willing to trade with you. This can cause delays and bad pricing. 2. Trading volume. Trading volume shows how much a stock is being bought and sold today. High volume means the stock is active and easier to trade. Low volume means price moves can be influenced dramatically by a single large order. 3. Bid-ask spread. The bid price is what buyers are willing to pay. The ask price is what sellers want to receive. The difference between them is the bid-ask spread. A small spread means the market is active and trading is efficient. A large spread means higher cost and less favorable execution. Chapter 7. Why beginners should always use diversification. Diversification means spreading your money across many different investments instead of putting everything into one stock. This can include different industries, different countries, or using exchange-traded funds. For beginners, diversification is one of the safest ways to start investing. You have now learned the essential terms used in the stock market. You understand stocks, shares, and equity. You know what dividends, price to earnings, market cap, and earnings per share represent. You recognize the difference between bull markets and bear markets. If you enjoyed this guide and want to keep learning, make sure to subscribe and turn on notifications. Let's continue building your financial knowledge.